Here's the big question. Is this an economic crisis or is this the first step in a master plan? The economy looks like it's falling apart. The markets are down. The prices are up. There are tariffs everywhere. But what if that chaos is actually part of a master plan? Meaning there's a theory out there that says this impending recession was actually engineered by the current administration, meaning to slow down the economy and to scare the markets and force the Fed to cut rates so that America can refinance its debt and reset the game. In this video, I'll walk you through, number one, the strategy behind the slowdown. Number two, how this mirrors Trump's real estate playbook. And number three, and what smart business owners can do right now, just like you, to come out ahead. Because this could very well be the great American reset. So let's break it down. Hey, my name is Sharran Srivatsaa, and I want to take this broad concept down, and without any B-roll or crazy graphics, I want to break this idea down for you to see, could this be the great American reset, so that you can have a conversation without sounding like a finance bro. So let's actually break down this idea of the great American reset. Now, there is this big question, which is, does the US actually need a recession to win? Imagine that as the big question. Does the US actually need a recession to win, or is this just part of a major master plan? And I'm going to walk you through the multiple domino that happened so that you can have a chronological impact and effect on what this master plan may actually look like without being triggered by whether this is a Trump policy or whether someone else is getting paid or whether this is all part of a big ruse overall. So let's see if there is a theory behind all of this. So why does the U.S. need a recession to win? So let's talk about tariffs for a second. For those of you who are living under a rock, there is a big conversation around tariffs right now. And tariffs, if you're not aware of it, is just a toll on imports into the U.S., meaning if a country wanted to send ship goods to the U.S. enforces a tax on that, and that tax is called a tariff. When you increase that tax, it increases the goods, the price of those goods, and therefore it feels like things are getting expensive here in the U.S. However, when you have reciprocal tariffs, it means that if we now tax China with the tariff, they're going to turn around and tax us. And because of that, there's this trade imbalance and all of these other things that happen, which creates a global economic kind of structural move. And the issue is that if a country like New Zealand did it, it wouldn't change. Now, by the way, I love New Zealand. I've been there multiple times. But New Zealand is not a mass consumer of the world's products. America is. So when America does it, it changes the game. So number one, the idea was, hey, the first step to all of this in the first 100 days of the administration was, let's actually put in high import tariffs. Means the U.S. hits all imports with high taxes for bringing goods into the U.S. What happens with that? It's actually positioned as a protection narrative, meaning it says that, hey, this is our way of protecting American jobs, meaning if the goods being brought from outside the country to the U.S. is more expensive, then companies will buy American-made stuff more, or the American companies and the American products are now get to compete because the products coming from the U.S. from abroad are not as cheap anymore. So that is one narrative around it, which is possibly true if executed well. The other is it's actually a strategic tool. And the strategic tool is that it's an economic policy instrument. And how it's used is it needs to be done very carefully because it's got to do with trade deficits. It's got to do with what are you actually exporting versus what are you actually importing. For example, the U.S. exports expensive stuff. So like semiconductors and turbines and jet engines and planes. So when the U.S. is sending $10 million worth of stuff of a product to, say, Australia and has a tariff on, and they have reciprocal tariffs on that. Well, and the U.S. is importing from China like brooms and mops and $2 items. Then net we stand to lose more. So that is the trade deficit math that everyone is unsure of and whether it's actually going to change what happens in the U.S. But strategically, the U.S. has already started to see net investment because people want to kind of play ball and don't want to get stuck in this entire tariff war. So the main idea was impose tariffs so that it creates this economic uh, economic policy instrument and has a lot of broader implications. And the stock market actually reacted to that. It went nuts. It had an insane frenzy. So much so that when there was a 90-day pause on tariffs, it had one of the highest stock market rallies in history. So part one of this puzzle was impose the tariffs. All right, let's go to part two. When you impose the tariffs, what happens? Part two is when you impose the tariffs, costs rise. So when the costs rise, now the brooms, the toys, the anything that we get from other parts of the world, those costs increases, which means the consumer prices go up. And this is mainly because of higher import costs, because the something that costs $1 to come in now costs more. Therefore, somebody has to pay for that, which means that if someone had to pay for that, it's probably going to be the consumers, because everyone knows that it didn't cost more to manufacture this product. It only costs more to get the product to the U.S. And when that happens, so let's say an electronic item like an iPhone costs you $1,000, and now it costs $400 more, 40% more. Well, what happens is the price of the iPhone didn't just go up, or the value didn't change. The price just went up, and when the price goes up, you automatically have a rise in inflation. And what is the job of the Fed? To manage inflation, right? So this is part two. What happens now is that because inflation happens and you have more Americans are actually spending more money doing their thing, this is what happens. There seems to have this feeling of an economic slowdown, meaning mainly the fear of a recession. Because you say, hey, higher prices will slow down spending. Of course, that makes sense, because if I'm actually spending 30% of my paycheck in my expenses, and now that has to go to 40%, well, something's got to give, right? And so higher prices leads to slowdown in spending. Number two, the business confidence starts to drop, because now businesses are like, wait a minute, if consumer spending is down, we can't sell more of our products, especially discretionary items. Other companies are like, wait, if I have to spend more on all of these, my costs are going to rise. I don't know how much they're going to rise. So the businesses start laying off people, which is very sad, right? And so that leads to even less spending, and the market starts to correct. Markets are like, hey, I don't know if we can do this, so I don't know about longer term valuations. So you have this market that was going up that starts to deeply correct downward. And this economic slowdown creates this fear of a recession. So when you have increased inflation and the fear of a recession, what happens? That's what we're trying to figure out. When you have that, right, something interesting happens. Now the Fed, which is the independent body, not controlled by the government, not controlled by the administration, when the Fed is now pressured to cut rates because they see inflation going up, and they see the economy slowing down, and they see the fear of a recession. So there's an interesting dilemma here. And the dilemma, let me actually read it for you. The Fed is forced to consider lowering rates to prevent a deep recession. Why? Because one, it has to balance inflationary concerns. Two, it has to respond to these economic indicators. And three, it doesn't really have to do this, but it has to manage political pressure. Even though it's an independent body, it still has to manage inflation and economic indicators, because if the market's going on a free fall downward below with the fear of a recession and the Fed doesn't do anything, then it feels deeply politically pressured. And that's what the theory is that the Trump administration is trying to do. Now, what happens if the Fed cuts rates? There's a reason why the administration is doing this, and we have to know that reason, because this may be just part of this grand master plan. And let's actually talk about step number 4. Well, what happens when this happens is that the interest rates drop, right? And so the interest rates drop, and let's say the Fed actually cuts the rates and the interest rates drop. A couple of things happen. We know this. There's never been an economic boom with high interest rates. We know that. And if the interest rates drop, it creates lower cost of capital for people to do things with, to invest in their businesses, to generate more spending. And companies want to have these lower cost of capital to do more things with. So the first thing that happens when interest rates drop is business owners say, hey, wait a minute, these lower rates are good. It helps me borrow money. I can borrow money and I can expand my operations. That's really powerful. That's the first thing. The second is, real estate investors love this. Low rates means, cheaper borrowing costs. So they find properties, they do development, and that actually generates, if you remember, the COVID-based housing boom happened because we dropped the rates, and it created an insane housing boom because the cost of capital was so low that people are now able to afford things that they could not afford otherwise, and it generated this frenzy of spending. So this happened especially with homes, and a way to just completely reboot the real estate market, the things that you and I are actively doing with. This includes other real estate projects as well, because real estate's a big driver of the economy overall. And then this is the key part. The key part is what happens to the government. And this is what the theory is. That when you have lower rates, it's cheaper borrowing. So what the government does, both state and local government, is they refinance their public spending. Essentially, they refinance their treasury bills, if I can write, their treasury obligations. And what are treasuries? The treasuries are just loans that backed by the United States government that the U.S. did its bonds on, right? And so we can invest in U.S. treasuries where the U.S. government is borrowing from the world. China is a large holder of U.S. treasuries. I hold U.S. treasuries. You may hold U.S. treasuries in your fund. It's considered zero risk because the U.S. can always print money to pay the obligations back. But if the rates are higher, there's also higher interest payments on these loans. And so with the interest payments being so high, and we have a huge, huge deficit. I mean, we have close to $38 trillion of deficit, and we're trying to figure out how we can actually refinance these loans so to reduce our interest payments. Now, you may be thinking, well, Sharran, what does it actually mean? Think about it this way. Say you have, I'll make up easy numbers. Say you have a $500,000 mortgage on your house, and say that you originally got that mortgage at 7%, right? Well, suddenly, let's say that those rates drop to 5%. And now you have the same $500,000 mortgage on your house, but instead of making the payment at 7%, you make the payment at 5%, which is significantly lesser, almost cuts your payment by 25%, which is pretty insane. And that's so the theory is that the government has this, the administration has this idea that they're going to, create the fear of a recession, get the Fed to lower the rates, and then refinance the U.S. debt. And the fear of the recession was actually just manufactured by policy and not by actually changing fundamentals. And so it can always snap back after they have refinanced the debt. That is the theory overall. So how does this actually pay out? So let's run some basic numbers through it. From my cursory research, out of all the debt that we have outstanding, it looks like in the short term, $9 trillion of it is eligible for refinancing, right? So $9 trillion of it can be refinanced. And if the interest rate decreased by just 1%, that would be close to $1.7 trillion of savings over 10 years. Just 1%. Right? Now, you may say, well, Sharran, that's not a lot. Well, that starts, a bunch of things happen. One, it starts happening here, but it also now, as we saw, it does a bunch of other things. It generates amazing things for business owners. It starts to create real estate investors to jumpstart the economy. And it also helps the government. So the big idea is, hey, not only does this help the government with the refinance, it also helps real estate investors, and it also helps business owners who are going to kickstart the economy and do more overall. And this is just for a 1% increase in rates, which is pretty amazing. So if you think about it, asset prices, like you may say, well, Sharran, does this actually work? How does all of this work? Asset prices, which is the prices of homes, cars, businesses, etc., are very interesting. When interest rates are lower, it makes money cheaper. That makes sense, right? And because of that, since it makes money cheaper, people buy more stuff. And because of demand and supply, when people buy more of something, the value of that thing goes up, right? And because of that, investors and operators who are positioned early will win big. This is your answer here. Investors, real estate investors, et cetera, and operators of companies who are positioned early when you get a lower cost of capital are going to win big because cheap capital equals high upside. Now you have access to credit, you have access to loans to expand your business, to hire the people to do the things that you could not do otherwise. And that's why increasing asset prices is very good for America. America's never had a boom with high interest rates. And so the idea is, a theory is, could they actually manufacture this fear of this recession to get the Fed to lower rates to create this growth in asset prices? Now, Let me actually break down. So if all of that kind of sort of made sense, I'm going to give you the full breakdown and walk you through the same steps over and over again. So let me quickly recap for you to see if this makes sense. So number one, tariffs were imposed, and the idea is to create market disruption. The main idea for the tariffs is to create the market disruption. The second is, because of all of those, it creates economic pressure, because these rising costs and slowing the economy is, if you have rising costs and slowing the economy, now it's going to force some intervention. The intervention comes from where? The Fed. The Fed now is semi-forced to maybe consider dropping interest rates. So the Fed cuts interest rates to prevent a recession or a deeper recession. And because the Fed cuts rates, the capital gets cheaper. And when capital gets cheaper, three people benefit, right? You have business owners that benefit, you have real estate investors that benefit, and you have the government that benefits. And because of all of that, borrowing becomes cheaper, and the government especially can refinance its large debt obligations at this time. And when all of this happens, something crazy happens, which an opportunity emerges. And now business owners can acquire assets and lock in more growth, because once you do this and the cost of capital is low, it allows for growth to happen. That is the big idea here. That is, how do you actually figure out, are the tariffs just a step one in this master plan of this great American reset? So my question for you is this: is this actually part of a master plan, or is this just the beginning of something that was not implemented well? Only time will tell, but I will tell you this: we cannot predict, but we can prepare. In this market volatility, just watch for the opportunities. And if the Fed ever ends up cutting the rates, you may be able to win by taking advantage of the low borrowing cost of capital. So this was my main idea, to talk to you about how to summarize what could possibly be the Great American Reset, so that you don't have to sound like a finance bro.